Hey there, Brian Bogner and Greg Towner here. Happy New Year to you. It's 2022, and unfortunately, this year, here in Greenville, South Carolina, we've kicked off this year with a lot of COVID Omicron virus and a lot of snow. So it's been quite an interesting start to the year. But one of the things that we do get asked a lot right now, hey, we had a great year last year, Brian. There's inflation going on. There's some, just the COVID is ripping through everybody right now. Why should we still be invested? Why, there's concern. What are the markets going to do? Things like that. So, what we try to do here is cut through a lot of the noise, right? There's a ton of noise out there. There's a ton of things that we see on TV. And we try to just get to some data points and some very specific things that we can look at and say, okay, based on this data, based on, we're going to make our best educated decision based on that. And so we're going to give you some of that data today. And we've got a little more slides here than usual, so hang with us. I think this is really important for you to listen and work through. So Greg, let's go ahead and take it away.
Okay, great. Yeah, thanks, Brian. Well, we always like to start off with a broader view of the stock market. This is the S&P 500 over the last few years. And we can see recently there's been a modest pullback. We've actually had a few modest pullbacks in recent months. I mean, the volatility last year was much lower than normal. I think the biggest drawdown was about 5%, which is about what we're doing right now as far as a pullback. I mean, normally most years you have multiple of those types of pullbacks, maybe a 10 to 12, 15% area as well. Haven't had that yet in the broader market. But under the surface, there's been a lot of damage, a lot of the more speculative areas of the market, some of the growth names, the non-profitable names, some of the small caps, those have all gotten hit a lot worse. So volatility maybe feels higher than it's been, but so far the broader market's reasonably holding in place. But I think the reason that...
Yeah, and I think that's important to note because I think that a lot of stocks, Greg, that have been in the news and that I think a lot of our clients maybe just follow out of, whether it's a hot name or something like that, a lot of that stuff's getting crushed. And so It's easy to look at that stuff and go, oh my gosh, the market's falling apart, the market's falling apart. No, actually, to your point, it's actually not. But a lot of what's more reported on in the news and things like that is. And I think it's important to make that distinction.
Yeah, that's a great point. And I think some of what's moving the market right now is actually the interest rate side. We've seen kind of a surge in rates here in recent weeks. It's a 10-year note. It's up to about 1.8% or so. Still low by historical standards, but it's moved up pretty quick here. And I think some of the concern around the market is the speed of it, but also what it means for what the Fed is going to do. They're starting to change their policy a little bit. They're going to be raising rates most likely this year. And so I think they're starting to get some concern that maybe the Fed is going to move a little too quick, maybe make some kind of policy mistake. It's not too unusual for people to get concerned about the Fed as they start their action. But why is the Fed doing what they're going to do? Well, what do we talk about almost every month, Brian, is inflation, right? And continues to be the case. Another month of a very high consumer price index number that came in here recently. So it continues to be a headwind for markets and for consumers to some respect. But I think when we take a step back, fortunately, the consumer by and large is in great shape. And we're going to show a few slides about that. First here on the left is consumer spending on durable goods, those bigger items, maybe some household type items, has been way above trend here since COVID hit. Consumers are spending, a lot on big items, durable items. And then, on the right-hand side on services, it dropped off quickly, of course, when the pandemic started. Nobody was traveling or going to restaurants and so forth. Now we're getting pretty close back to trend. So consumers, the U.S. consumer, one thing you can always count on is they spend and they're back to spending. So that's a good sign for the economy. What's allowing them to spend? Well, of course, I think as most people know, the job market is super strong, and that as a result is pushing wages higher. So the typical consumer has the ability to go ahead and make purchases that maybe they would normally not do as much of.
And as a business owner, I mean, here parallel, I can speak to that. We've got a few job openings right now, and we're trying to hire, and we've grown and we're expanding, and it's been great. But when we get into the compensation piece, it really is a challenge right now because that market has just moved so quickly and so far this past year. that yeah, it's tough finding people, and then also paying them as well.
And it's not just wages going up. Fortunately, most assets have been going up. I think all of us here in the Southeast know how strong the housing market has been. I mean, it had already been strong, but now look at the last couple of years. Prices have just surged higher. It's great if you're a homeowner. It certainly is more challenging if you're looking to get into the market. And at some point, you would think prices will stop people from buying. But at this point, due to lack of supply as well as the overall environment, it's continued to move higher. And I think that the next chart is a really important one to display that. This is the debt service payments as a percent of disposable income. So because consumers are making more money, because interest rates, despite the recent uptick, have been low, they're able to afford more and more than in the past. So that has kept the housing market in part strong. And why are we focusing so much today on the consumer? Because inflation is going up, we want to make sure the consumer can keep doing what they do. Long-term chart here, back to the 1950s. For the last couple decades, the consumer here in the US has made up about 2/3 of gross domestic product. And it's even surged here in the last couple of years, pushing 70%, 68, 70% now. So as long as the consumer is such a big part of the economy, and as long as the consumer is spending and doing what they do, that is a good sign for the economy as we move along.
So just to summarize, we do see some stock volatility increasing, as we said earlier, but and these are just typically in some very specific areas, in really in a lot of the media stocks, or not media companies, but stocks that are being mentioned in the media a lot. We're seeing a lot of volatility increasing, but overall, the broad market is up. Inflation is still an issue. It's look, it ticked up to 7% here recently. It's still a problem. When will that end? When will that change? We get asked that a lot. I don't know. Hopefully sooner than later. But the positive is that the consumer is still very healthy, and they're still able to spend. They're making money, even though the housing market's up. Even their debt service payments are a much smaller part of their actual budget than they were back, in 06, 07, 08, when we were dealing with the housing crisis there. So, and the consumer is obviously important because it makes up the majority of our economy, and they're strong. So at this point, if people ask us, we continue to be bullish because these overall trends are up, because the consumer is still strong. You're going to get pullbacks, you're going to get some volatility, you're going to get things in there, but overall, we still tend to be bullish at this time. So if you have any questions, you know where to reach us. Here's our phone number, email address. Thank you so much for watching, and have a great day.